Good old Coreweave, the company that NVIDIA put a floor price on at $40, saying they would buy up to $250 million of shares of Coreweave anytime the stock trades under $40, is having a bad day. At the time of this recording, it's down 17% on the day after earnings, and it's losing support after support after support. And in this video, we've got to talk about why we would see this sort of euphoric rally post-liberation in April, to now what's turning out to be a bleed out confirmed by earnings that are likely to continue this bleed out. We need to understand why this is happening. First, it's important to remember the cycle here. Why would NVIDIA promote investing in Coreweave? Well, it's pretty simple. See, NVIDIA makes chips. We know that. Well, they don't actually manufacture them. They just design them. Better hope that China doesn't take over Taiwan, because 90% of our chip manufacturing would evaporate if that happened. But anyway, yesterday, I got myself one of these, the NVIDIA 5090. And I realized that the streaming computer I had been using, and actually still am using because I'm still setting up the 5090, it was using a 4090. And I'll have you know that's 2-year-old technology now. So, you know, when it came to using AI processing for a green screen, which I rarely use, but when I do, it just isn't keeping up anymore. So like the software is exceeding the technological capabilities of the chips we had essentially 2 years ago. So I find that very interesting, that we're kind of already on this upgrade cycle. And that becomes really important because, see, as a customer of NVIDIA, owning, I don't know, maybe 5 4090 chips, which we now use for AI, in-house sort of ML training that we do at night over at HouseHack, which is great because we don't have a rush for it. Very, you know, they call it latency insensitive training that we can do. But anyway, what we find is that the technology gets old, and when it gets old, I'm not mad at NVIDIA. I bought the 4090 knowing it's going to get old at some point, and I'll put it to use on something that doesn't need instantaneous, pressure of workflow, and I'll go buy a new one. And so now here I am with the 5090 that I know is basically going to be worthless in 2 years. Maybe not worthless, but it'll be worth a lot less in 2 years, and it'll probably be worthless in 4 years. And I'll still love NVIDIA. I'll still come back and go buy the 6090 or the 7090, 7, something like that. I'll still do that. And I'll still love NVIDIA, even though their stuff becomes worthless after 2 years or 3 years, right? And don't mind me complaining about the fact that the chip, which is basically the thickness of this, is pretty much like tiny, and the rest is all a heat sink and fans. Kind of crazy. That said, Coreweave buys this junk, and they hold it. They hodl these chips. And that becomes really important because they support NVIDIA by buying the NVIDIA stuff, the SMCI server rack build-outs, the AMD processors. They buy this stuff. All those downstreams win. Vertiv with the water cooling for Blackwell, they all win immediately. But Coreweave holds the bag, okay? That's the old news. We know that longer term. So what's happening now that's making us a little bit more curious about Coreweave, now that we've got sort of some of the basics out of the way about how this functions with Coreweave and chips, okay? This is gonna get into some of the nitty gritty, but there's a lot that we have to understand. So the first thing that I'd like to do is I want you to know that they borrow money at expensive rates. This is their earnings call from the earnings that just came out. And they talk about 3 financing deals that they just participated in. Of the 3 financing deals, 2 of the deals were in the, quote, high yield space, which is a fancy way of saying junk debt. And then their third deal, which they were cheering about, was SOFR plus 400, which means they're probably paying SOFR plus 1,300 on the other deals, okay? That's really, really high. Now, what is SOFR? Well, you could Google what SOFR is today, the secured overnight financing rate. You don't really have to know exactly what all of that means, but basically it's just a floating rate that changes every single day. Today, SOFR is 4.36. So if you're paying SOFR plus 400, you're paying 8.36% interest. If you're paying SOFR plus 1,300, you are actually paying, well, in this case, plus 1,300. Yeah, you're paying like 17% interest, which is insane. Crazy junk bond level debt. So why would lenders be charging such exorbitant levels of interest on Coreweave's debt? Well, because the lenders are actually realizing what I just told you about the 5090 and the 4090 chips. Lenders realize that the underlying asset will be worthless at some point. Now, it won't necessarily be 2 years, okay? Maybe that's extreme. Like the 4090 is still good today, right? But let's be real. In 5 years from when these chips come out, 5 to 10 years, call it, they're almost certainly going to be worthless. This is very different from buying real estate. So, for example, my real estate startup, HouseHack, probably ending that fundraise within the next month or so. Househack.com, read the paperwork over there if you want. But with HouseHack, we buy houses, fixer-uppers, and apartment buildings, and we develop properties and accessory dwelling units. And we expect in these high-quality areas, these assets are going to maintain their value for 30 to 100 years, right? Because we maintain them. Every month, we maintain them. We have a maintenance expense, and we keep them up. And because they're in locations people want to live and there's a lack of supply, the value of these assets goes up over time. Chips, on the other hand, become worthless over 5 to 10 years. And that's why you're seeing the actual lenders be pretty aggressive in the financing rates they have against Coreweave. This is a problem. Coreweave is basically also a commodity provider. And in providing this commodity, the best thing you can do if you're a provider of a commodity is have committed, reserved data usage. So if you have 10 data centers, you want to know, like imagine these 10 data centers are like 10 rental properties. You want 100% occupancy, right? You want all of your data centers firing on all cylinders. But what happens when you have your 10th data center, let's say, so 10% of your data centers, like, we don't have tenants right now. Okay, well, when you don't have tenants that are going to reserve spacing, you might consider throwing it into the hotel market for chips, the Airbnb for chips. We call this the on-demand and spot market. In other words, if I want an H100 right now for 1 hour, what is it going to cost me? Somewhere around $2.40 an hour is what it's going to cost you. So for $2.40 an hour, you too can have an H100 processing your crap for an hour. All right? And you pay $2.40. Now, why does that matter? Well, it matters for a few reasons. Spot pricing, or this pricing for on-demand servers, specifically H100s, has been plummeting. Take a look at this. This is the spot market for an H100 based on hyperstack.cloud/GPU-pricing. Their H100, which came out October of 22 and really broadly came into use in the first and second quarter of 2023 through the artificial intelligence revolution, and then later in 2023 through Elon Musk and XAI purchasing a ton of these chips. You really saw the build out of the H100s in 2023, and these chips are coming up on 2 years old right now. So we're 2 years old on the H100 cycle. And what are we seeing after 2 years on H100s? Well, let's go back 1 year. So when the chips were 1 year old, Hyperstack was selling them for $3.40 an hour, 44 cents an hour, okay? Reservations, which would be your long-term tenants, only $2 an hour, $2.06. But on demand, per hour, $3.44, okay? That was when the chips were about, call it 1 year old. Then they turned into little 18-month-old babies. This is using the Wayback Machine, so sorry, the rendering is a little funky here. But the Wayback Machine shows us that the GPU pricing on the on-demand side, which is your excess capacity side, fell from $3.44 an hour down to $3 an hour, which is about a 12.8% decline in pricing from when it was 1 year old to 18 months old. Then when we go to pricing today, we can see the on-demand, this is very important, on-demand pricing per hour is down at $2.40 per hour. $2.40 per hour after 1 year represents a pricing decline of 30%. It's about 30.2% decline in pricing per hour. Now this on-demand side is important because the on-demand side is different from your reservation side. The reservation pricing hasn't moved that much, but that's because these are people willing to make long-term commitments. The excess capacity, so the place you're gonna see the first set of damage on pricing is always going to be on your vacant units, your on-demand stuff. And what's depressing here is not only do we have this 31% decline in pricing over 1 year on the excess demand or excess supply product, I should say, right? There's excess supply, so lack of demand. We have vacancy, which represents a little bit of a lack of demand on demand. That's wordy, I understand, but that's a pretty big decline. And look at what Coreweave is telling you. Coreweave is telling you, hey, we want to expand our footprint into on-demand. Oh, why do we want to do that? Because we think it's important. What? That's it? Like, hey, why do you want to do that? Because I want to. Wait, that's the CEO's answer? Are we serious? Hold on, Kevin, are you reading this right? Because the CEO, Chief Executive Officer, says, and we really want to be able to continue to expand our footprint there, around on-demand, because we think it's important. Oh, okay. So you want to expand your footprint into the Airbnb of chips where pricing just declined 31%, when the age of a chip went from 1 to 2. That's where you want to expand your footprint. Well, how much utilization are we going to have for these chips when these chips are 5 years old, right? What you want is you want more 5-year lease commitments. See, OpenAI in 2023, there was such a shortage for these chips, they gave Coreweave a 5-year commitment. And this led to a lot of excitement. People were like, oh my gosh, OpenAI is going to promise to lease these chips for 5 years. But the thing is, they've already walked back this talk about 5-year lease commitments, and now they're only willing to say we're signing multi-year contracts for Blackwell. They're not telling you they're doing 5-year contracts for Blackwell. They're telling you they're doing multi-year, which multi-year is anything more than 1. So could be 2-year contracts, could be 3-year contracts. And the reason you're probably seeing this is because if you're Microsoft, why would you go, or OpenAI, why would you go to Coreweave today as there's more supply of these data centers? Why would you go to them and say, hey, we want to pay a top tier price for 5 years? When on the margin, pricing is plummeting for these per hour servers because we're starting to see supply catch up. On top of that, and this was a very interesting observation that somebody came up with here. This user, James Woodman, said there's something very interesting going on about accounts receivable growing 1.5 billion in the first half of 2025. This revenue growth, this revenue backlog is growing materially with an increase in the amount of short-term buckets. Coreweave is basically making a bet that the companies are going to be able to monetize this compute profitably, otherwise they can't pay their bills. Now this was very interesting. And so then what I did is I went into the financials for Coreweave and I wanted to corroborate what this user was saying. And so really, as I change my zoom, my highlighting goes away. That's a scam. Okay. No problem, I remember. Shouldn't have done that. Anyway, look at the accounts receivable right here. So accounts receivable for Coreweave, there we go, my zoom came back. Accounts receivable for Coreweave exploded to 1.9 billion. That's 4x, it's actually 4.5x explosion in accounts receivable. Well, how much did their plant, property, and equipment go up? They went from 11.9 to 16.6, which is an increase of about 40%, 39-ish and some change. So their plant, property, and equipment, their actual infrastructure grew by 40%, but their billings grew by 4.5%. Now, there are two ways you could look at that. You could look at that and go, hey, like that's great. That means they're making more money, right? Or it means they're just not getting all their payments as quickly as they previously had. So let's try to figure that out. Their revenue in the first 3 months ending, or the 3 months ending June 30th, was about 400 million in 24. Okay, 400 million in 24. About 100% of that was receivable. Oh wait, hold on. That's not a comparison. I can't make that comparison. Darn it. This shows me the 3 months ending 2024 on June 30th. But this over here shows me the end of the year. Bummer. But anyway. All right, so to the end of the year, that's a little less clear. But anyway, the point is, the receivables right now exceed our revenue substantially. Our revenue right now is about $1.2 billion, and receivables are almost twice that at $1.9 billion. At the end of 2024, we had about 400 mil of receivables, and we don't know, revenue was some level of this. But the point is, they were, today, a lot of their money is hopefully coming through. Now, we don't actually think that they're going to default, or like these people that owe Coreweave a lot of money are on the edge of bankruptcy and they're not going to pay their bills. So I'm not that skeptical that this cash won't come through, but I know some people are. And it's just sort of something to keep in the back of the mind and pay attention to. I don't see it as a massive red flag or issue right now. But it is interesting to see a lot more of that cash that should be showing up, maybe should be discounted a little bit. And the reason this is important is because Coreweave has a lot of current debt. Look right here, current liabilities. And I'm gonna remove deferred revenue because deferred revenue, as we'll talk about in just a moment. If you look at deferred revenues, you've got $951 million of deferred revenues. Take that off of current liabilities. You've got about $6.5 billion of debt due in the next year. So think about this for a moment. Let's say you had $650 worth of bills due within the next 12 months, okay? So you owe $650, which is actually it's actually $6.5 billion for Coreweave, but for you, it's $650. You owe $650 over the next year. Okay, cool. What's your money coming in? Well, you've got $115 in cash, and you've got $200 of money supposedly coming in. So if I add that together and I assume all of my receivables are going to show up, 200 plus 115, I've got $315. And I need to pay $650 worth of bills over the next year. That's problematic. I don't have enough money to pay for my bills over the next year. And that's one of the problems over here. And that's why I started by talking about some of the debt and the high interest that they're financing, high interest rate debt that they're financing. One of the reasons they have to finance debt at such high interest rates is because they don't have the money to pay their bills. So they have an asset, this plant, property, and equipment side, that they're only depreciating at, somewhere around $500 million a quarter, so $2 billion a year. So we'll talk about depreciation in just a moment as well. But they're telling us it's not really becoming worthless that quickly. Don't worry, everything's fine. We're going to keep borrowing against this $16.6 billion, but we don't have enough money to pay for our bills over the next year. So we're going to go out and we're going to keep borrowing money at really high interest rates because the lenders realize that we're borrowing money on assets that are probably going to be worthless by year 5, which is not good. So that's problematic. Now, if we look at the cash flow statement for the company, this is where we could see how much they're depreciating. They're depreciating about $500 million every 3 months. That'll be important in just a moment. And they blew about $3.9 billion in capital expenditures in the last 6 months. So they're burning about $2 billion in CapEx every quarter. And so it makes sense that their revenue is going up because what they're doing is they're basically buying more rental property, right? So revenue growth, totally reasonable if you're borrowing a bunch of money and you're deploying more rental property, essentially, server stacks. Of course your revenue is going to go up. But we don't really care about that. What we care about is, hey, what's the underlying profitability of this business? Like, how much money is this business actually going to make, and what's the return on investment that they're getting? All right, so this is where I made some return on investment calculations. And I find this very interesting because what I wanted to do was find out how much of a return is this company actually making on their assets. Well, here we go. Right now, we're making about $1.2 billion of revenue on $16.6 billion of assets, right? So 1.2 billion per quarter on 16.6 billion in assets. We have operating net income of about $500 million per quarter. And that's because we have $700 million of costs per quarter on 1.2 billion of revenue. Now, where can we see that? Right here. We look right here, knowing from their cash flow statement that expenses are about $500 million for depreciation. We could say that let's take out of the OPEX off of the 1.2, 500, and we end up with $700 million of costs of goods sold, which means we really have an operating income of about $500 million, equal roughly to their depreciation. So their net operating return on $16.6 billion of assets is $500 million per quarter. That works out to $2 billion per year. So imagine you had $16,600 and you were getting paid $2,000 of a return per year on that, okay? So you get a $2,000 return on 16.6. That works out to about a 12% return. Sounds pretty good, right? That's before interest. So we're not even considering interest on the debt right here. But the problem is, of that $16.6 billion, we are losing about 1/5 to depreciation per year. So 16.6 divided by, or just times 0.2 is 3.3. So we have $2 billion of operating income, not including interest, less a loss of $3.3 billion in chip value, which means we are actually losing $1.3 billion per year on this business on $16.6 billion of assets. That works out to a negative 7.8% return on assets. So I want you to think about that bottom line for a moment. Considering a 5-year worthless time frame for chips and $700 million operating profit per quarter with 500 mil of depreciation already factored in, so 700 does not include the 500 mil, to be clear, right? You are losing, this company is returning negative 7.8% on their chip investments at this point of $16.6 billion per year. And it assumes the chips will still create value in year 5. But again, when we factor in what's happening in the on-demand pricing and what's the life cycle of chips, this is a pretty fat assumption. These chips might be totally worthless by year 5. So this is a problem. It's a pretty big problem. So you have a negative return. Mind you, this negative return is occurring without considering interest. So subtract interest of, what are they paying in interest right now? They are paying, oh my Lord, $250 million in interest in 3 months. Subtract interest of $1 billion per year, and this is a money burning bag holder. Now, in the short term, it doesn't look like a money losing bag holder, right? In the short term, like when this IPO'd and was $40, I'm like, hey, in the short term, this will actually probably do very well because people aren't going to think about how in the long term, the stock's gonna burn a lot of money. So in the short term, it made sense why it was doing so well. And people just look at, oh, the revenue is exploding, this is great. But when we actually look at some of these deeper fundamentals, it's actually quite concerning. On top of that, take a look at this. Somebody here writes, in their last earnings presentation, Coreweave mistakenly revealed it's running a Ponzi scheme. You can see it in their slide. Coreweave collects prepayments for a contract. So now this really complicates the analysis, because a lot of the analysis that we just did assumes that the revenue that they're recognizing is revenue that they're able to keep getting. But what if some of the revenue that we actually just factored in is really just a prepayment? You know, so in other words, if I have a 3-year contract and I got paid for a year up front, that means the revenue is actually way higher that they're showing me right now than it actually is. If revenue includes prepayments substantially, then this business will be even less profitable, or I should say will lose even more money. Lose even more money in the future, as prepayment revenue does not equal recurring revenue. Right? It's revenue that looks good today, but it's here today, gone tomorrow kind of thing, which is not good. On top of that, you know, you've got Jim Cramer who says Coreweave is good. You know, I probably should have just started the video with that. But anyway, this is something to think about. Like, how do we feel about these 5-year depreciation timeframes? How do we feel about the value of these chips in 5 years when on-demand pricing is already plummeting to the tune of 31% in the span of, you know, the chip being 1 year old to 2 years old? How do we feel about burning $1 billion a year in interest and basically being treated as a junk bond company by lenders? Or you know, a junk debt company, I should call it. How do we feel about their cost of goods sold sitting at $700 million once we take out depreciation, meaning they've got you know, profits of about $2 billion a year, quote unquote profits, but you know, when we extract depreciation, or you know, the money we're losing on these chips on $16.6 billion, we're actually returning a negative, because these are not assets that are going to be worth much after, you know, 5, certainly to 10 years. I don't know. I think that's probably why you've got a CEO that's starting to argue, hey, we're repurposing our old chips with new contracts, because they have to you know, or we're moving it to on-demand. It's kind of an early red flag that they're having to reposition these assets because people don't want the H100 anymore. The people with the capacity to pay the most money today don't want to pay for an H100. They want to buy the Blackwell chip. But the Blackwell chip will also be dated, you know, in 2 or 3 years. Kind of crazy. So that's my take on what just happened at Coreweave. It's a lot to digest, and some of my assumptions could be wrong. So, you know, this is, I showed you everything where I got my information from, my opinions from. So, you know, Coreweave, don't sue me, bro. But if I've made a mistake anywhere, I'd love to hear from you in the comments. Someone says, I wish I could repurpose my chips. Yeah, no kidding. But yeah, I'd love to hear what y'all have to say. So leave me a comment on that Coreweave analysis.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.